Hey investors, welcome to my channel, where we turn complex financial reports into actionable insights. In this video, I will walk you through companies' key business metrics, analyze their growth trajectory, and break down their financial performance in simple, clear terms. So let's get started. Asian Paints is a manufacturing company that provides decorative and industrial paints, along with home decor solutions. The company operates in over 60 countries, with a presence across Asia, the Middle East, Africa, and the South Pacific, reflecting geographic diversification. The workforce consists of 12,000 employees, indicating a substantial operational scale. In the past 3 months, the stock decreased 9.98%. Asian Paints operates through 4 key segments. These are the decorative business, the home decor business, the international business, and the industrial business. The decorative business, contributing 88.2% to the company's revenue, offers interior and exterior wall finishes for both homes and commercial spaces. This includes paints, waterproofing solutions, wood finishes, enamels, adhesives, and essential tools. The home decor business, also contributing 88.2% to revenue, provides a range of home solutions. It focuses on modular kitchens and wardrobes, decorative lighting options, and a variety of fabrics and furnishings. The international business, accounting for 8.7% of the company's revenue, delivers decorative paint products and solutions tailored to diverse customer needs in emerging economies around the world. It features both exterior and interior finishes and color solutions. Finally, the industrial business, which generates 3.1% of revenue, supplies custom-formulated coatings for automotive, general industrial, packaging, marine, and other specialized applications. This includes automotive coatings, industrial protective coatings, and powder coatings. Now, let's look at the shareholder returns of this company. This year, both the company and its industry faced challenges, with returns at -21.99% and -33.87%, respectively. Interestingly, the broader market saw positive returns of 8.83%, showcasing a divergence that the company may aim to bridge in the near future. Let's examine the company's steady revenue growth. Revenue grew by 6.48%. Looking at the quarterly trend from Q3 2023 to Q3 2024, revenue decreased from 91 billion INR to 85 billion INR, showing a fluctuating but overall negative trend. The company shows stable cost management capabilities. Gross margin stands at 42.26%. Since Q3 2023, this number has shown a fluctuating trend, starting at 43.43%, dipping to a low of 40.59% in Q2 2024, and ending at 42.26%. Operational efficiency shows notable improvement. Operating margin is at 16.21%. The trend from Q3 2023 to Q3 2024 shows a decrease from 20.29%, a low of 12.46% in Q2 2024, and has ended at 16.21%. Profitability shows positive momentum. Net margin is 13.03%. Over the past 5 quarters, we've seen a fluctuating trend, starting at 15.95%, hitting a low of 8.68% in Q2 2024, and ending at 13.03%. The company maintains healthy liquidity levels. Current ratio stands at 1.8. Looking at the quarterly trend from Q2 2023 to Q2 2024, we've seen a fluctuating pattern, initially increasing to 2.1 by Q4 2023, before decreasing to the current level. The current ratio tells us how easily a company can pay its short-term bills. Think of it as having $2 in your checking account for every dollar you need to pay this month. Generally, a ratio above 2 is considered strong, showing the company has ample resources to meet its short-term obligations. The company shows balanced debt management. Debt-to-equity ratio is 0.5. From Q2 2023 to Q2 2024, this ratio has decreased to 0.5 by Q4 2023, and then has seen an increasing trend. This ratio is like comparing your mortgage to your home equity. A lower ratio means less financial risk. Generally, a ratio below 0.5 is considered comfortable, though this varies by industry. The company maintains stable debt servicing. Interest coverage ratio is 28.2 times. The quarterly trend from Q3 2023 to Q3 2024 shows a fluctuating pattern, with a low of 16.2 in Q2 2024. Think of this as how many times over the company can pay its interest bills, like having $9 available for every dollar of interest payment. A ratio above 5 typically indicates strong financial health. The company delivers solid returns to shareholders. Return on equity stands at 25.8%. This measures how efficiently the company uses shareholder money. Think of it as the return on investment for company owners. Generally, a return above 15% is considered attractive to investors. The company maintains a robust cash position. Cash to total assets ratio is 1.5%. From Q2 2023 to Q2 2024, we've seen a fluctuating trend, peaking at 2.8% in Q4 2023. This ratio tells us how much of the company's resources are in readily available cash, like having emergency savings in your bank account. Generally, a ratio above 15% indicates strong liquidity. Now, let us analyze how this company is performing when compared to its peer. The company's price-to-earnings ratio is 50, while their competitors are averaging around 51. In simple terms, you're paying 50 rupees for every 1 rupee of company's earnings, compared to 51 rupees you'd need to pay for the same earnings at their competitors. This lower valuation suggests you might be getting better value for your investment compared to its peers in the market right now, though it's worth investigating why the market has assigned this lower valuation. The company's price-to-sales ratio is 6.29, while their competitors are averaging around 5.79. What does this mean? You're paying 6.29 rupees for every 1 rupee of company's sales revenue, compared to 5.79 rupees for competitors. This higher valuation suggests the market expects superior sales efficiency or growth potential, though you're paying a premium for each rupee of current sales. The company's enterprise value to EBITDA ratio is 30, compared to the industry average of 29. In simpler terms, this higher ratio indicates the market is placing a premium on the company's business value relative to its operating performance. While this might reflect expectations of stronger future performance, it also means you're paying more for the company's current operational efficiency. Now, let's break down what analysts are expecting over the next 2 years. According to analysts, the company is expected to show earnings per share of 44 rupees in 2025, growing to 49 rupees in 2026, representing an 11% growth. For context, in Indian markets, a growth company typically shows earnings growth above 15 to 20% annually, while mature companies usually grow between 8 to 12% per year. Looking at revenue estimates, analysts project 11% growth. Generally, growth companies in India should show revenue growth of at least 15 to 20% annually, while mature companies typically grow revenue at 7 to 12% per year. Asian Paint's key strategic initiatives are multifaceted. First, the company aims to expand its retail presence by increasing availability to 169,000 retail counters across India, with a focus on newer towns and suburbs. This initiative seeks to make the product more accessible to customers. Another key area is the focus on premium and luxury segments, with the company launching innovative products that provide value-added features while prioritizing sustainability and environmental protection. Apex Ultima Suprema Aero Clean, with its pollution-neutralizing technology, is one key example of this. Furthermore, Asian Paints intends to strengthen its B2B business by capitalizing on increased capital expenditure in India, targeting factories, government projects, and the hospitality sector. The company plans to offer specialized services to secure and expand its B2B market share. Additionally, Asian Paints will drive its decor business, focusing on growing the home decor business, which includes kitchen and bath offerings, providing consumers with diverse decor options, using collaborations and store openings. Finally, Asian Paints will leverage its brand through marketing investments to maintain mindshare and emotional connections with consumers, including campaigns for Ultima Protect, Safe House, and Season 8 of Where the Heart is with Celebrities. Asian Paints' capital allocation priorities include several key areas. First, the company is investing in backward integration projects, specifically the VAMVAE project at Dahej and the white cement project at Fujairah, Dubai, to improve value from the supply chain. According to the context, these projects are currently on track. Another key area for capital allocation is marketing and brand building to build mindshare among consumers. Additionally, investments are being made in mechanization and training, with the establishment of training centers across India to train painters in mechanized painting techniques. This aims to increase speed and reduce hassle during painting work. The company is also investing in new product development, focusing on innovation and the development of new products in the luxury segment, as demonstrated by the launch of products such as Apex Ultima Suprema AeroClean with photocatalytic technology. Finally, increased investment in sales and distribution channels is observed due to heightened competition. The execution track record of Asian Paints demonstrates strengths in several areas. The company has continued its retail expansion, reaching 169,000 retail points through increased store openings. Additionally, the Beautiful Home Painting service has seen sustained acceptance and growth, expanding to over 650 towns with strong NPS scores and referrals. The context shows that new products contributed 12% to overall Q3 revenue, indicating a consistent ability to innovate and commercialize new offerings. Furthermore, the industrial segment has outperformed the decorative segment, showcasing management's ability to capitalize on opportunities in diverse markets. The stated metrics show sequential improvement in gross margins from 41.1% to 43.2%, attributed to material price deflation. Asian Paints' forward guidance includes several key projections and concerns. Management expresses cautious optimism for near-term recovery over the next 2 quarters, banking on rural demand, B2B business, and industrial segment growth. The context specifies an emphasis on maintaining PBIT margins between 18 and 20%, signaling a commitment to financial discipline. Additionally, management anticipates some softening in raw material prices, which could potentially boost profitability. A key concern is the weakening rupee, which could impact import costs. Finally, the company expects double-digit growth in the B2B business. These expectations are viewed as ambitious but potentially achievable due to government projects. So, what do you think about this company's future prospects? Would you consider investing in this company? I'd love to hear your thoughts in the comments below. If you found this breakdown helpful, please take a moment to like this and subscribe to the channel. It's completely free, and your support motivates me to create more in-depth analyses every day. Thanks for watching, and I'll see you in the next video where we'll dive deep into another exciting company.